Advisory services offered through VestGen Advisors, LLC, an SEC-registered investment advisor. Securities offered through Private Client Services, LLC, member FINRA and SIPC. Private Client Services and VestGen Advisors, LLC are unaffiliated entities. Any information discussed does not constitute investment advice. VestGen Advisors and Private Client Services do not offer tax or legal advice. People of Chicago, welcome to In the Know Radio with Craig Bolanos, co-founder and wealth advisor at VestGen Wealth Partners. You want help from someone you can trust, someone who knows what it takes to get retired and stay retired. Today, Craig's going to teach you what you need to know. So get ready to learn something that could change your life. Get connected to the show by calling 833-964-PLAN or go to getretiredstayretired.com. And now, here's Craig Bolanos.
Hey, good morning and a very happy Sunday to you, giving you the sincere and actionable ideas that you need to improve the lives of yourself and your loved ones financially. That's what we do every single week. And that means if you want to get retired, you want to stay retired, you want to start thriving, not just surviving in retirement, you need to be armed with information that, yes, is investment related, information that is planning related, information that integrates your taxes, your estate plan, and your retiree healthcare. You bring all of those things together in one cohesive strategy from one firm, and that's how you start leveling up your game to optimize. And first, I think about 2026. We're getting ready to close out the month of January, and I've been hammering the table on this. And I think we're going to hammer it again. It's information you can't afford to miss because it affects your 401k balance, your retirement account balance, and it's a geography lesson. I mean, in the 80s, everybody had globes. I mean, my co-host here, David, you remember when everyone had globes back in the 80s?
I got one for my 8th grade graduation.
Hell yeah, everybody had a globe. It was fantastic. We had small globes, big globes. Globes were all the rage. I don't know why. Lots of things were. I mean, I remember people putting Garfields on their cars as well. But the lesson here is one of geography. And I want all of our listeners right now to be thinking hard about geography. And David, when we address, and you specifically sit down with clients at VestGen Wealth Partners, how are you addressing this discussion of geography, which I think takes some people back? What is it all about?
Yeah, well, I think we're all, as investors, right, guilty of recency bias, right? So what's worked in the past will continue to work moving forward. But if we take a step back, we understand that markets move in cycles. And we went through a time period, just about 15 years, where the US was the best place to be from a performance standpoint. That didn't mean foreign stocks didn't make any money. They just didn't keep up. Well, as of last March, last April, it looks like that trend has started to shift the other way. With a weaker dollar, foreign stocks are doing much better. And even if you include last year's performance, on a relative basis, look a little bit cheaper than the United States. So I think the key is as we're doing some rebalancing, some recalibrating of portfolios, we want to make sure that if we don't have any exposure, that we add exposure outside of the US. And for those that already have some, perhaps we need to do some rebalancing and tiptoe into some asset classes that might have slightly cheaper valuations moving forward.
That's exactly it. Guys, this de-dollarization trade is not ending. We talk about things that are cyclical and we address things that are secular. Cyclical is short term. It lasts a couple of months. That's not what this is. This de-dollarization trade, unfortunately, is more secular. It looks like it's got staying power. It looks like central banks around the world. It looks like sovereign wealth funds around the world. It looks like foreign investors. No one's going to sell their U.S. assets. That wouldn't be anyone's interest, but they are going to continue to buy less dollars every single month. And if that happens, you're going to continue to naturally see the U.S. currency marginally decline. Said another way, it's more expensive now when you go to Mexico. It's no longer buy one tequila, get one free. You want to go ahead and hit the trifecta. You want to go to Rome. You want to go to Venice. You want to go to Florence. It's going to be 13 to 15% more expensive than it was a year ago. All of that is because of the currency. And just remember that in a time of a weakening dollar, U.S. investors, that's us, are rewarded with tailwinds from international allocations in the portfolio. I think you should want to learn more. Give us a call at 833-964-PLAN. That's 833-964-PLAN. Go out to our website, getretired.com. That's getretired.com. David, one of the things besides geography that you're consistently focusing on with clients is that ballast that's in the portfolios. And part of that ballast is, of course, bonds, or what some people affectionately refer to as fixed income. But I think it's important, given the headwinds that are here, let's talk about this, that investors really pay attention to duration yet again. David, what is duration? What's the risk? And why might someone want to be a little shorter than the benchmark on duration this year?
Yeah, it's almost like fixed income has become kind of like the ugly stepchild that no one wants to talk about, despite investors maybe allocating a third of their portfolio to bonds for some type of safety. But I think where we're at today is, and you didn't ask about this, but I think this is important. First, we want to look at credit, right? And credit spreads are pretty tight right now. And what that means in layman's terms is, if you're buying into lower rated securities in search of higher yields, you're not really being compensated for taking that additional risk. So we believe that there's really not a reason to allocate too much money to higher yielding securities, because there's not a lot of value there today. If you stay kind of more in that middle ground area, you can get some higher credit quality and yields that are still pretty competitive. But we don't know where rates are going to be. And with all of this pressure on the Fed, Craig, I mean, it's hard to make a call. So I think that as investors, they kind of need to stay in the belly of the curve or in shorter term fixed income to kind of hedge their bets moving forward, because this market's been so dynamic for bond investors.
833-964-PLAN. That's 833-964-PLAN. Go out to our website, getretired.com. Listen, if you're in a target date mutual fund, if you have a traditional balanced allocation, you may have as much as 30, 40, 50% of your money allocated to the bond market. You need to be paying attention to how you're doing bonds. And we're in an economy, guys, that might just run hot. Let me say that again. We're an economy that might just run hot. That's a good thing if you want to prosper in America, but it's a difficult thing if the inflation spikes again, because the economy could run hot. What could cause the economy to run hot? Well, the first thing is OBA, the One Big Beautiful Bill Act. Are you kidding me? This is great. OBA is creating all of this stimulus. It's also creating all of this federal spending that puts money into circulation. And the more of something, right, the more of something, the less valuable that thing becomes. So you need to pay attention to that. Number two, there's been tremendous deregulation across industries. Deregulation in and of itself is stimulating. Number three on my list, read the headlines, especially bond investors, those of you in mortgages. There's movement by Fannie Mae, Freddie Mac, buying some $200 million of mortgages to push mortgage rates lower. Wait, what does that do? I think it stimulates the economy. Pinch myself. Everybody goes, we need to be lowering rates. Well, we got one, two, we got 3 rate cuts last year in the back half of the year. Guys, that's all stimulus. Oh, and last time I checked, instituting tariffs on virtually all of our trade partners, what does it do? Well, it can boost some prices, but it also brings in revenue to the country. Again, stimulative. So part number one, David's having conversations with all of the clients about geography, the importance of currency and international investing. Part number two, don't rest on your laurels, everybody who has bonds and fixed income. Pay attention to one of the hidden dangers in a run-hot economy, which is a resurgence in inflation. and make sure you're working with investors that can create permanence and definition in your bond portfolio by moving beyond simple bond mutual funds and incorporating bonds in different wrappers the way they're intended. And if you can tell I'm passionate about this, I am, because I'm penning an article right now to put out there in print to remind people that 2026 is starting in a similar way to what 2022 did. What are some of the best performing sectors year to date? Oh, I don't know. Materials, energies, commodities. Saw that before. Maybe that's an indication that the Fed changing its focus from inflation to employment means in order to steady the employment ship, they're going to let the inflation stay high. What does that mean for your investing portfolio? Well, good heavens, that's what we've been discussing all morning. Listen, I want you to connect with David. I want you to connect with me, 833-964-PLAN. Go out to our website. That's getretiredstayretired.com. When you're on the website, I encourage you to download some of our fantastic publications so you too can be connected on our outlook 2026 and take advantage of a complimentary consultation where we can ensure that we listen to you. You deserve to be heard. You deserve to be seen. And if you want to put everything together, you're ready for a higher level of care. That's exactly what we can provide to you via VestGen Wealth Partners. Okay, when we come back, we got to give you more sincere and actionable ideas that you can be using on the investment side. And of course, we are going to be talking taxes. Why? All of your forms are starting to hit your mailbox in the coming 5 to 10 business days. I need you to be prepared because there are some things you can do to neuter the 2025 tax bill still in 2026. That's information you can't miss. You're listening to Craig and David Bolanos in the know, VestGen Wealth Partners on AM 560. The answer.
It's more In the Know Radio with Craig Bolanos on AM 560 The Answer, where his goal is to pummel you with financial know-how until you say uncle.
Run hot economy. What's a run hot economy? A run hot economy is when all these forces converge to allow economic expansion to go longer and further and better than people thought. And in case you didn't know, I think that's the recipe that we have here. Have you seen the recent GDP growth? Are you listening to the fact that we could have real GDP growth adjusted for inflation in the 2 to 2.5% range? We absolutely could. But this is one of those years. And a focus on quality, relentless focus on quality is going to matter. Because David, you and I have talked about the fact that consensus earnings for the stock market this year are double digits. I mean, as high as 12 to 14%. But the reality is this could be the first year in 4 where stock prices don't track earnings per share. David, how can a higher elevated starting PE, and what is a PE, what could make that cause stock markets not to perform in line with stock market earnings in 2026?
Sure. So that's a term that you hear on TV a lot, price to earnings multiple, right? So how much is an investor willing to pay per share of earnings, right? So the first thing I would say is valuations have historically been a poor timing indicator, meaning that stocks can be expensive, not just for months, but stocks can be expensive for years. And to your point, Craig, last year, what I think is a really good takeaway was if you look at the big technology companies, as those stock prices appreciated and you looked at their earnings, you could lay those lines on top of each other. That's a good market to be invested in. If we saw stock prices appreciating, but the earnings may be going sideways or down, that's not an investment that most people would want to be a part of. But after a couple of years of elevated stock prices, right, the alarm bells are out to say, hey, if you're adding new money to some of these securities, are you paying too much? Hence, our suggestion for folks to look to allocate maybe some money outside of the United States, to look at some non-dollar denominated asset classes. But I think for investors right now, as you're going through your portfolio and you're recalibrating, it doesn't just have to be US stocks to foreign. There's lots of different stocks out there to invest in. So it might just be rebalancing from a sector standpoint. Just because to your point, Craig, where we have a problem is if stock prices appreciate, but the earnings don't justify that. And at the very end of last year, you started to see some of these, what I call like ghost companies, start to pay the price, meaning companies that didn't have the earnings. You saw double-digit declines in stock prices in Q4. It was kind of hidden beneath the surface. But if you owned one of those stocks, I think everybody knows what I'm talking about.
Absolutely, 100%. So keep in mind that a quality bias is probably going to be of importance this year. And David, maybe that's the reason that we're seeing an outperformance year to date of equal weight indices versus cap weighted indices. It's just one more illustration showing why quality matters. Now, David, when you talk about great companies of America and we do our speaking engagements, David, what's a great company of America, and why are growing dividends, not high dividends, the hallmark of great companies that are tested in the trenches?
Great companies of America, to me, are companies that you actually understand what they do. So why are they relevant today, and why are these companies likely going to be relevant in the future? All of them have great management teams. They put shareholders' interests first. And a lot of these companies have free cash flow, and they're returning some of their profits to investors in the form of a dividend. Now, we don't need to be always buying the highest dividend yielding stocks. One of the metrics we look for is very simple. Which companies have been growing their dividends consistently over time? Because management wouldn't grow the dividend if they were having financial trouble. So I think that's a very basic sign of a healthy company where every year they're increasing their dividend. And if you're someone that's approaching retirement or already in retirement, and we're thinking about building some inflation hedges in our portfolio, growing dividends is one of the ways that we can help offset inflation, in addition to some of the other asset classes we already talked about.
David, I think that's really key. Dividends, dividends, dividends. Because after all, we've long talked about the three pillars of retirement income. One, preservation of capital matters. Once you've made it, do everything you can to not lose it. And David, what are steps that people should take consistent with pillar one of retirement income? Capital matters.
To me, that means we always have some type of safety valve in the portfolio. We like to call it a cash flow reserve account, but it's a buffer in case we have, depressed stock prices for an extended period of time. As investors, we never want to be forced to sell when stock prices are down, but the only way that you mitigate that risk is that you proactively have some of those cash reserves on the side, so that if we have a 6-month time period of depressed stock prices, you're not selling, you're just liquidating your short-term reserves so that you can continue to keep the same cash flow and wait for the market to eventually recover.
And I think that leads well into what we were discussing, which is pillar number 2 of retirement income, is you need to generate sufficient dividends and interest to cover your spend. Because if you can take dividends, interest, payments, distributions, all to cover your spend, then you're not going to need to touch the corpus of the portfolio. And that's why David focused so clearly earlier today on investing in those great companies of America with rising dividends. David, talk about how you can use various forms of alternative investments in today's marketplace to increase and support pillar number 2, which is generating sufficient portfolio income.
Sure. So I mentioned that we might not be just searching for the highest dividend yielding stocks. Oftentimes, our preference is for companies that grow their dividends, grow their income on an annual basis. And right now, I think everything in investing, Craig, is we're dealing in relative terms. But what I would say is dividend growing stocks trade at a slight discount to the rest of the market, at least based off historical metrics. But some of these companies that are growing their dividends might only be yielding 1 or 2%. So that's not going to get people excited. It might not get them to their goal. So to your point, we need to start supplementing some income from some other sources. And those other sources could be infrastructure related, real estate related. And the really unique thing about that is with a little bit of due diligence, depending on where you own some of those investments, not only can you generate dividends 4, 5, 6, 7%, a lot of times those dividends come through taxed advantage. And that's really where we create some longer term momentum, because as we always talk about, it's not just about what you earn on paper, it's what you keep net of income taxes. And those types of supplements, I think, are something that should be on everybody's agenda in 2026 to say, hey, does this make sense for me based off my liquidity, my appetite for risk, and what I'm ultimately trying to achieve with some of these dollars?
And David, that's right. That's why in an upcoming segment, guys, we're going to talk about how the next frontier in investing isn't a new asset class. It's just a new way of giving people access. But we've been talking about the 3 pillars of retirement income. Capital matters, generating sufficient portfolio income that's dividend, interest, and payments to cover the spend. But we can never look beyond pillar number 3. You have to grow your capital base over time in order to grow your income. And David, how do things like international investments, great companies of America, and the disruption, the AI arms race, how can that help support pillar number 3 of growing our capital base in today's environment?
When I think of pillar number 3, I think of Warren Buffett, right? Find good long-term trends and throw yourself in front of it. And so it could be AI, it could be AI infrastructure, but there's lots of long-term things because there's a lot of beneficiaries of AI. So I don't think it's a one or the other, right? It's all of that stuff probably makes sense for investors to consider for their personal portfolios. But we have to have some capital on the side. I just had a client meeting the other day where she had mentioned that her friend was talking about using an annuity and said how it's great to generate this extra money. But her concern was it's great to generate the money today, but if we put too much money into something like that, that payment's never going up in the future. And she was concerned that while it feels good today, 15 years down the road, it might not work. And I thought that was a very, very astute way for her to decide whether or not that was something she wanted to participate. It may have been a great thing for her friend, but for her personally, she was more concerned of the cost of living exceeding what that annuity would generate. And she decided to keep things liquid and just go a different way. And that's how we have to evaluate some of these things.
833-964-PLAN. That's 833-964-PLAN. Go out to our website, getretiredstayretired.com. That's getretiredstayretired.com. Download today, Investment Outlook 2026. Download today for free, Investment Outlook 2026. And when we come back, I need to make sure you understand the new frontier in investing. It's not a new asset class. It's just a different way for people to access. Craig and David in the know, AM 560, The Answer.
You want more in the know radio? You want more in the know radio? You can't handle more in the know radio. Okay, yeah, you can. And it's on AM 560, The Answer. Welcome back. Here's more with Craig.
Hey guys, the number of public companies continues to shrink. And if the number of public companies is continuing to shrink, that means something else must be expanding. And that's private markets. And investors are really asking themselves how to sensibly include private equity, private credit, private real estate, infrastructure into portfolios. And I got to tell you, this rise in private markets, it's impossible to ignore. Impossible to ignore. I mean, since 2015, that's just 10, 11 years now, the amount of money attracted into private markets has nearly tripled. Let me say that again. It's nearly tripled. And the concern has long been, the challenge has long been accessing those private markets through a format that's very thoughtful, intelligent, and investor friendly. And I tell you what, David, at VestGen Wealth Partners, we have curated just that. David, talk about the sense of pride you have with what VestGen Wealth Partners has created in terms of its alternative investment offerings, both in evergreen, drawdown, and all of these different semantics, because there's 31 flavors, but just like the ice cream, there's a flavor for not all, but most investors.
Yeah, I mean, we spent a tremendous amount of time building out the behind the scenes infrastructure and due diligence process to make sure that we were offering what I call best in breed non-traditional investment strategy, private placements, private equity, you name it, it's on our platform. But I think the most important thing, Craig, is for us is this is just part of our DNA at VestGen. This isn't something that just got created out of nowhere. We've been participating in these strategies for a long time. I think investors, quite frankly, were well served being in publicly traded markets the last 10 to 15 years. There was no need to maybe start embracing some of these other strategies. But now that the format has changed, now that they have perpetual offerings, now that we can avoid drawdown funds for some families that don't want to wait to have capital go to work, the opportunity set looks better. And with the market trading where it is today, I think it's something that everybody needs to learn about. But I want to go back to something real quick, because you mentioned, right, like we're not seeing perhaps as much activity or IPO activity. Companies are staying private longer. Why do you think that is? What really started that trend to keep some of these companies private as opposed to just going on an exchange and the founders getting wealthy, let's say?
Well, I think it's simple. There used to be a point in time when the only way to pay off the founders was to have an initial public offering. But now no one hears about IPOs anymore. You just don't hear about them. And the reason for that David hinted and alluded to is there's this whole other adoption of ways to pay off the founders, and companies can raise monies without having to go to public markets. And when you're raising monies by not going to public markets, I think it provides an environment that might have more flexibility. Why more flexibility? The leadership of that company, the board, still has a fiduciary duty to all of the shareholders, but they're not going to be as slaven to making their numbers every 90 days. A private company is going to be able to focus more on that 2 to 5 year result. What are the KPIs, key performance indicators, that we need to achieve to hit our multiples of invested capital, in some cases over a 2 to 5 year period, and doing that through a private investment versus the public spectacle sometimes allows for greater flexibility in the management and stewardship of a company when you're not managing to 90-day deadlines or once per quarter. I don't know how well I articulated that, but that's really what it is, David. So David, spend a minute and talk a little bit about how people might want to consider some of the easiest forms of alternative investments today. One of them I'll just mention again is private credit, right? I mean, private credit has become just one of the most practical on-ramps for investors looking to get started. And private credit, when done right, can generate consistent income, oftentimes floating rate income, meaning it's going to change with prevailing interest rates, but with cash distributions that are on a monthly or a quarterly basis, especially when people do it in the correct wrapper. I think it's a great entranceway to an asset class that's not showing any signs of slowing down. But there's another side, David, that you're really a fan of coming into 2026, which is real estate. Talk about why that's attractive.
Yeah, well, I think I'll set the stage by saying first, when we are allocating dollars to some of these asset classes, what I think of is we're just trading public exposure for private exposure. So one is not better than the other. They're very complementary of of one another. And oftentimes the reason we're doing this is to help create better risk-adjusted returns. One of the benefits for a lot of private investment strategies, whether it's credit, private equity, private infrastructure, real estate, is those asset classes tend to be more non-correlated to the market. And when they have that non-correlation, they provide a little bit more stability in the portfolio. And when we're doing it, as you mentioned, the 31 flavors, there's lots of parts. But I think a key for us, and I know me personally, is I don't allocate my personal capital to just one flavor. We're still trying to build out a diversified portfolio of these strategies, just like we might build out a diversified portfolio of stocks or ETFs. And for me, you mentioned real estate, right? What I always tell people is look, we have, all of your money in stocks, bonds, ETFs, right? We want something that might not be a stock or a bond. And you can buy real estate in two ways. You can buy real estate stocks, or you can buy the physical real estate. And in the most simplest terms, the way I think about it is the next time the stock market has a major decline, the way the world works today is I'm sure most stocks will all go down at one time, right? Because the market moves us algorithms. The market's either you're in or you're out. But when you own the hard asset, right, you don't have to always see everything move in the same direction at one time. And that's the design. So yes, we could just go out and buy an ETF of real estate stocks. But what has us interested is, real estate had a pretty significant decline a couple of years ago. Looks like the bottom started to be put in potentially. We're now 7% off the bottom. You have slowly declining interest rates, which is great for real estate. And if you're an investor that's looking to generate dividends from your portfolio, lots of private real estate offerings have dividends north of 4%. And a lot of that stuff comes through tax efficiently. So we can't call a bottom in real estate, but we know is it had a really tough 2 years. 2025 appears to be the start of the recovery. And if you want something that has zero correlation to publicly traded stocks and bonds, it's definitely an asset class that you might want to be on your radar. But again, it's contrarian because it had a tough go, but it looks like after 2025, things have smoothed out.
I thought it was all about buying low and selling high. So take advantage of the disparate pricing arbitrage via various forms of assets, those that are publicly traded and those that are private. 833-964-PLAN. That's 833-964-PLAN. Go out to our website, getretiredstayretired.com. That's getretiredstayretired.com. Work with myself, work with David, where we can help express to you the opportunities, the strengths, but explore the weaknesses and the threats that are involved with all forms of asset class and capital allocation around the globe, so you too can worry less, which allows you to live more and pursue everything you've worked your entire life for. Download for free today our Investment Outlook 26. That's our Investment Outlook 2026. It's up on our website, getretiredstayretired.com. Download Investment Outlook 26 today. All right, more to come. Craig and David Bolanos, VestGen Wealth Partners, in the know on AM 560. The Answer.
Would you like a dose of knowledge? Good, because Craig is back and about to fill your retirement prescription. Back to In the Know Radio on AM 560. The Answer.
Go out to that website, getretiredstayretired.com, and download our Outlook 2026 so you can be armed with the information that you need to be successful. But remember, it's not just about IQ, intelligent quotient. You need to work with people that have the other form of IQ, implementation quotient, because people are drowning in knowledge today. The internet's democratized information, but the ability to implement that information in a timely fashion that's specifically curated from you. That's something we do well, and we do it very well at VestGen Wealth Partners. David, before we move into something that is absolutely critical on the asset protection side, you thought it was key to come back to this movement into private markets and specifically the timeliness of real estate. What did you need the listening audience to know?
Yeah, let's just hit those bullet points again. So I think one is relative valuation, right? Stocks have appreciated a lot. Bonds made money last year. Real estate had a tough 2022, had a tough 2023, but the recoveries began. So I think there's valuation, good values there. Number two, interest rates going down, benefit for real estate. And number three, right, ripped from the headlines, right? Like what does Washington want to have happen? They want to get housing moving. So we haven't kept up. We haven't built enough housing, right? Supply has been low. We're trying to get that to move by maybe reducing regulations, continuing to lower interest rates, but that sets it up. And I think the last thing is depending on what flavor of real estate you go with, this isn't the real estate of 10, 15 years ago, right? When we talk real estate today, if you're a believer in tech, part of real estate oftentimes is being involved in things like data centers that help some of these big technology companies. Sometimes being in real estate is industrial real estate. Think distribution centers for everybody shopping online. You have to think to yourself, do you think those trends will continue? And if you do, right, then perhaps it's time to take a look at some of these other asset classes. So I think it's perhaps a great time to just take some profits off the table and repurpose them into other types of securities that are playing on the same thematics, but where you don't have to pay a premium necessarily.
833-964-PLAN, 833-964-PLAN. Go out to the website, getretiredstayretired.com. That's getretiredstayretired.com. Download for free Investment Outlook 2026 today. David, asset protection is such a big part of the business that doesn't get discussed enough. And a part of that asset protection is all the things we do on the estate side, creating the revocable credit, shelter, irrevocable trust so people can keep their hard-earned assets, make sure money stays through the bloodline. But another part of asset protection is on the insurance side. It's about future-proofing. And all throughout last year, and we're going to continue for a couple more months, we've been talking about that avalanche issue in American financial planning, which is long-term care planning. And it's something that hits hard for us. It's something that I know touches so many of our listening audience. And David, when people want to learn more and they want to get educated on the asset protection side for long-term care so that people can age gracefully in their home and protect choice, how does that conversation usually look with you, with people in the conference room or through a virtual platform?
Very personal decision. I find that lots of folks are either pro or anti-insurance. And a lot of times the conversations come up because someone has gone through a family experience. Maybe they cared for a loved one, or maybe they had to financially support a loved one, or maybe it was both. And I look at it as this is an investment, right? It's another form of investment, but that investment is to protect perhaps all of the other stocks, bonds, ETFs, whatever you're invested in elsewhere. The key is, one, when are we going to look at getting this placed? Because I always tell folks, and maybe you think of this the same way, we're going to have the conversation once and we're going to agree whether or not we're going to explore this further or we're going to walk away. It's not necessarily a decision that you can come back to every year because, as everybody knows, the insurance only gets more expensive as you get older, and it gets more difficult to be underwritten. So if we're not going to go the insurance route, well, then maybe we need to be allocating dollars on the side and just relabeling an account long-term healthcare. So that's where it starts. A lot of times families bring it up to us and they'll say, what's available today? Because we've had an adverse experience where things just got out of hand from a cost perspective. And how do I hedge out that risk for my family? And I think it just is re-educating people on what some of those solutions look like today, because the solutions that we're using here at VestGen are not the same solutions that people were looking at 15 or 20 years ago when long-term care insurance first hit the market. Maybe you can explain just some of those key differences, Craig.
Well, let's talk about that. Listen, if you're going to move into something that's asset protection related because you care about spousal impoverishment, and a reminder, spousal impoverishment means if you're married, the healthy spouse is always going to get the amount of care that they need. Why? Because it's your loved one. It's your best friend in life, your husband, your wife. You're going to spend every dollar. But what if you start running out of dollars and the healthy spouse now becomes financially impoverished? It's a very real challenge in America. You're going to solve and you're going to curate that, but you're probably going to do it different, as David alluded to, than you did in the past. Because traditional long-term care policies where you enter into a contract and you pay a premium for your entire life, they're fought with problems, meaning escalating premiums with no end in sight, difficulty because it might just be reimbursement, it might not be indemnity. I'll talk about that in a minute. I think the new solution where you need to be, and it's been out there for years now, is you need to be solving for long-term care by making premium payments in a lump sum or make payments over a finite number of years so that policy is fully paid up, guaranteed, non-cancelable renewal, which means you have no premium risk ever. If you're going to invest in asset protection, then you need to ensure that the premiums you commit are guaranteed to be used for benefits during your lifetime if you go on claim. But if you die without ever using the benefits, you need to make sure the money is left to your heirs, your spouse or your adult kids. That way it is not use it or lose it. So let's do a solution that has no premium hikes. Let's do a solution that's not use it or lose it.
And let's talk about that timing thing. I mentioned the first thing that we need to think about with timing, which is if we wait too long, it might get too expensive and we might not be healthy enough to qualify. But let's also think of the timing as really a financial planning endeavor, because in a perfect world, just like we encourage a lot of our clients that we want to pay off all the kids' student loans before they're retired. We want to get a lot of the home upgrades done before we retire. We want to have the mortgage paid off before we retire. Wouldn't it be nice to also have that long-term care paid off before you retire? So if you're 2, 3, 4, 5 years out from retirement, you get ahead of this. You can set up a plan so that while you still have cash flow coming in from your employer, you can divert some of that money, get the long-term care paid for, and then as you move into retirement, you don't have that extra bill coming through. That's a lot easier to swallow than to retire and then add more bills. No one wants to do that. We're trying to, reduce expenses going into retirement, not add more. So to the extent that we can plan for it a couple of years ahead, that really puts people in a good position to be successful.
So I think you're going to solve for it by having premiums that aren't going to increase in value over time. You're going to solve for it by having your asset protection not be use it or lose it. I think you're going to solve for it by looking hard at whether you want reimbursement or indemnity. Indemnity is even more flexible. The insurance company just pays you cash, and then you dispense that cash however you choose for your family to get the critical care. I want you to learn more. Go out to our website. That's getretiredstayretired.com. That's getretiredstayretired.com. When you're on that website, download our free investment 2026 outlook or download a short introduction to long-term care for free so you too can start getting educated.
Okay, Windy City, get ready to be blown away with a hefty gust of financial know-how. You're listening to In the Know Radio with Craig Bolanos on AM 560. The Answer.
And all these other firms that people might be able to access, because there truly is a higher level of care. Give us some points on how that's distinguished.
The vast majority of families we end up engaging with don't come to us because they have financial problems or financial fires to put out. What I think gets them in the door is just this, idea of inquisitiveness, right? They're curious to know if there is a more holistic approach, a better way to start integrating all of these different disciplines. That's who we end up working with. These are folks that probably have the puzzle pieces, but haven't yet started to put together the puzzle. And they're looking for a firm that's going to advocate for them. And the way I define a really good advocate in our business, Craig, is an advisor or an advisory team that's thinking 2 steps ahead, not 2 weeks ahead. Where do we need to get to 3, 4, 5 years down the road? And what are the small steps that we're going to take today to slowly move the needle to get you from a place that's okay or good to optimal? And a lot of times we meet these families at an inflection point. It could be a change in job. Perhaps the kids are now out of the house, or they're starting to get serious about their retirement. And if you find yourself in that position, all I would say is we don't need to come in and talk about non-traditional investing. We don't need to talk about direct indexing. We want to sit down and just listen. What's important about money to you? And the way I explain that to people is just have a cup of coffee and a conversation, and we see where it goes.
833-964-PLAN. 833-964-PLAN. Go out to our website, getretiredstayretired.com, getretiredstayretired.com. Connect with David. Connect with myself. Let's seek to understand what's important about money to you and your family, and truly provide the full suite of services that a family office for regular folks deserve, because you too should want to level up your family's financial security in 2026. So once again, that website, getretiredstayretired.com. That's getretiredstayretired.com. You've been listening to Craig and David Bolanos, VestGen Wealth Partners, in the know on your favorite station. That's why we call it AM 560, The Answer.